Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So China sees that parallel and that's one of the other reasons they're digging their heels on the currency front. Obviously, they've been subsidizing their exporters in a very, very big way to keep this game going. China has put, I think last year, about half the amount of their total GDP has been thrown into the market to keep this demand game alive, all types of export subsidies. But it's also led to a massive amount of oversupply in China, so a lot of their companies are running on wafer-thin profit margins and too much global capacity, and that's part of the deflationary pressure we're seeing. Although we're in a world of very scant demand, the final goods capacity is soaring because of the money flowing to China, not only from the West, but also from Chinese government directly subsidizing their exporters and their major infrastructure companies, which are the home to most of the jobs, state-owned industries and jobs in China. So it's leading to, as I said, final goods prices being pushed down. Besides the other financial effect of deflation pressuring down, we'll get to that in a second. Foreign companies being beaten up a bit in China. China is protecting their own. The natural resource problem, we're seeing China, crack down on those rare earth minerals over on the export side, and they're getting more belligerent militarily, as we've seen their spats with Japan and others in the southern China Sea, and their edicts that they claim various islands and that are in major dispute. So a lot of things going on. And what I don't have listed here is also riots in China. We've seen a huge increase in the number of riots in China. Of course, they refer to them as incidents. They don't use the word riots. Mostly, it's not direct riots against the communist government, but it's riots by people that have just been unfair. Their land has been taken from them. Their houses have been taken from them from major developers and local governments to enrich themselves. So that's where that's coming from. But needless to say, they've hiked up in a big way. So there's some unrest in China. So China likes to do these types of things when they have unrest to whip up nationalism. All countries tend to do that to a degree, but the communists are very, very good at it. One of the things that you can look at, if there's one graph to see what the problem is, and the squeeze on China, and the demand still falling from the U.S. despite what the government's doing, despite what QE1, quantitative easing ones, and the Fed has done. This white line is a graph of U.S. consumer credit. And as you can see, the credit crunch changed the picture here. Credit crunch right in here, 2007, 2008, hit in a major way. And we saw what we think is a secular change towards debt, which means we're not going to see the U.S. consumer rebound to those levels they were in the past. They're going to continue to write down debt. This is not a cyclical event. If this was a cyclical event, as the Fed keeps trying to tell us and the economists keep trying to tell us, because that's part of their ploy to try and make us believe that quantitative easing will work. If this is a secular event, we wouldn't see consumer credit turnover for the first time since, I think this chart we have it going back to 1943, and this is the first time it really shows a real turn down in consumer credit. So, and at the same time, this orange line, as you can see, was pretty highly correlated, happens to be an index of the China's GDP. So we have a situation where China's major customer is the U.S., the white line, and they want to keep this game going, but the demand is falling out and has to be replaced. So here's the problem in here. The U.S. consumer, does he rebound? And part of this whole QE2, obviously, is to get the U.S. consumption back on track. But as I said, it's not working because of what we can think is a secular change towards credit. And we're now in that, which some people call I forget what the term is, but we're at a point when you get close to zero interest rates, the money market isn't working as it should, so we have some other dislocations going on there, and I'll get to that in a second. But this chart, I think, if you had to look at one chart to see where the global rebalancing problem is, this is it right here, which means China's growth either has to turn over and start to slow, or U.S. consumption has to rebound quickly. And we don't think U.S. consumption is going to rebound because there's still private deleveraging going on in the big way. And that's why all this money being thrown into the market on the fiscal and monetary side, that's part of the reason it's not working. There's just too much debt and leverage out there, and it's changed in a very, very big way. And this money is sitting, as we know, in the banks of the balance sheets of banking institutions. If you look at the monetary base, it goes something like this, and then the credit crunch, and it goes like this, and it's turned over a little bit. So the Fed has poured basically, all these funds into the banking market, but those funds are not getting into the real economy, and they're not getting into the real economy because borrowers have changed on the retail side and the institutional side, and obviously jobs haven't rebounded, and confidence and on the like. So what does Bernanke do, and what does the Fed in their infinite wisdom want to do? Since QE1 hasn't worked much at all, they want to do QE2, quantitative easing 2. And it really is this idea of trying to reflate the economy, and they're fighting against private deleveraging, and it's a major global tug-of-war. So consider this, that it's not just the U.S. that's deleveraging. You're seeing it happen in the UK, obviously. We're seeing it happen all across the Eurozone in a very, very big way. We haven't seen it start happening yet in Australia, but most people think, and most analysts point to the fact that they think Australia's housing market's overvalued by about 40%. So if we see a break, some type of break in the demand for Australian commodities and that economy were to start down, we could see the demand drop out of there very, very quickly as their housing prices start to move down. The housing prices, as we know, is a major wealth driver, and the wealth driver and your feeling of wealth changes your patterns of consumption. So, again, Australia looks like it's a wonderful place to be, and it is. They are in the sweet spot still because of the demand from China. But if China's GDP turns over, we could see some warts show up in that area too. And if that were the case, it would be bad news again for the global economy because we'd have to put Australia, Eurozone, and the U.S. in the same, kind of in the same boat. This is the quote from Bernanke from 2001 that gave him the name Helicopter Ben. And basically, he just says, the Fed can use the printing press to produce all the dollars they want and try and get some inflation into the system. Inflation, defined specifically from an economic standpoint, is a decline in the purchasing power of your currency. That is inflation. Your currency buys less. And this is part of this process that Bernanke has been trying to do with QE1, and these what they've been floating in QE2 just adds to this pressure, and obviously it's hurting the dollar. This is an implicit that's become basically explicit policy of using the U.S. dollar to weaken the U.S. dollar to try and pump up global asset prices, to try and it's working, as we know, all that money, dollar money being created. It's from a standpoint of a consumer wealth effect, our portfolios are those that, and well, not mine because I'm not much of a stock investor, but for those that are invested in stocks, the increase in the value of the 401k hopefully creates a little more wealth effect, but that's a very temporary and kind of a soft factor, but that's part of this process of trying to pump up asset prices.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.